Ladies and gentlemen of the crypto space, we're live on a Monday, September 25th at 11:33 a.m. The story we've told over the last couple of years involves peering through the madness, peering through the bullshit, and to see what actually is real versus what is mostly bullshit. And that's a story I like to talk about as often as possible. And it's most important to talk about it on days like today when the macro conditions look absolutely catastrophic. And that gives us a sense of where we are, what are the current conditions, and the path and trajectory that we're on. This is why we talk about things like survivability. What is actually going to survive? And to assess what is actually going to survive, it needs to be actually something significant, not the general term, the BS term utility. It's not. What is the utility? You got to get specific. You got to get granular. You actually have to talk about the details, the nuances of what makes something actually meaningful to separate it from the absolutely useless, like the other chart that we have up here. There's nothing significant here. There's nothing significant. And obviously, I'm saying that in part from a price point perspective, but I'm also talking about it in part from a functionality, a use case perspective. It doesn't do anything significant. It's not related to the real world. I've talked about very specifically the real economy versus the financial economy. And anything that is able to provide something useful to one economy or the other has significance. And significance, what is significance? That means that there is a desire to consume it. The bid. Without the bid, there's no longevity, there's no sustainability. It means it's not significant. And what are the predominant enterprises in crypto markets? This is a crypto channel. We'll talk from that perspective. Credit, liability printing, exchanges for speculation on price points, and that's an enterprise unto itself, but what you're exchanging doesn't necessarily have significance, and that's why I focus predominantly on stable coins, dollar liabilities, because there's significance there. That has real world use case. And transaction fees associated with cross chain. FX is the narrative there, be it the exchange of liabilities on a single chain or transferring those liabilities everywhere. That has overtones of FX written all over it. So that's it. That's all there is. Anything else is magic fairy dust. Where does the yield come from? Where does the revenue come from? Clearly, you have the dividend overtone from an enterprise, but then you have to assess each of these protocols that we like to look at from an enterprise standpoint. And most of the enterprise revenue is going to come from credit, liability printing, transaction fees from FX, so on and so forth. So there's only one relatively novel enterprise, but it's probably safest to say it's novel from a general public standpoint. It's the financing of liquidity. Now, I see the potential for this to have a historic financial system existence, but it doesn't really scream to me like how it occurs. Maybe there's like a cross-currency arbitrage where this kind of financing can be finagled, but it's just not as simply put together as it is presented from a crypto market standpoint. And that's predominantly two relatively successful federations. And that's the Balancer Federation and the Curve Federation. Now, the only reason these systems have worked at all has been identified by me in hindsight, and that's because of the way the United States emerged post 71, really post 74, and dollars for oil, and the way the rest of the world started accumulating U.S. treasuries, and the way the rest of the world basically financed U.S. fiscal policy. So the U.S. wanted to spend money. They sold these bonds to the rest of the world. The rest of the world bought them, which gave the U.S. dollars to spend on fiscal policy. So the entire regime was dependent on the rest of the world sterilizing, consuming the bond issuance. And they removed those bonds from circulating supply and they held them in a savings account, which obviously from a macro perspective right now that every country around the world is spending their savings account. That's why yields are doing what they're doing because of oil prices. Because at the end of the day, when you have a savings account, you're going to spend what you have in order to get what you need because all that exists in the end is energy and consumer staples, so on and so forth. Okay, so we have identified over the last couple of years how the U.S. got to where it is today with regard to financing its fiscal expenditures. So basically, the Treasury market was an inflationary regime where the units, the actual individual securities, the supply kept increasing, it was inflationary. Now, we apply that to this incentive regimes that we've seen in crypto markets over the last couple of years, and we quickly see the same thing with regard to using an increasing supply of units used to incentivize behavior, and that is not what we've seen with the vast majority of the entire landscape, meaning the vast majority deployed the incentives, but the incentives weren't kept in reserve in a savings account. There was no reason to, because they weren't significant units. They weren't significant currencies. How did you buy something with them? How did you buy oil with them? How did you buy consumer staples, food, pay rent with them? You had to first convert them to dollars. So that's why treasuries in part have the entrenchment, because the treasuries receive dollars as their dividend, as their yield. So this inflation of these units in crypto markets, you receive shit. Not dollars, not for all but few of the incentive regimes, and that's basically just balancer and curve. So the most important thing when digesting the nuances of these incentive regimes is where the core revenue comes from. So the core revenue for these incentive regimes comes from transaction fees, particularly from curve. So balancer is a little bit different. We'll focus on curve because it's furthest along and the predominant incentive regime that has the only chance of survivability in my eyes because of the sterilization. Now, what plays out with incentive regimes that don't have the sterilizers? I mean, first and foremost, you're just going to get continuously diluted. If you're completely dependent on individual actors to continue to sterilize supply, such as predominantly like Velodrome on Optimism, it's just people. It's not like you have protocols, protocol after protocol after protocol that are sterilizing supply. It's individuals, and they're incentivized because of the relatively high rates of return. But over time, those high rates of return should continue to decrease if it's just the individual actors that are the sterilizers, because the individuals respond to yield, an opportunity. They're opportunistic. So the beauty, and that means that incentive will decrease over time. Therefore, there'll be less supply disruption and just less dilution. So there could be interesting cyclicality in there. So I don't completely rule out the potential for survivability. I just don't seem to see the same characteristics with regard to third-party protocols that are deterministically disrupting supply. As I've said, it's the human that requires an incentive. The human is opportunistic, but a contract that is programmed deterministically gets rid of the human from the equation. So that's what I appreciate by far the most about the likes of Convex and the dozen or so other protocols that are sterilizing circulating supply of CRV. They are contracts, and the good ones are deterministic. They are immutable contracts. Like Prisma's very explicitly stated to be immutable. Convex CVX CRV is quite immutable. And we all know that Convex holds the majority. So that is quite a notable statement as compared to other protocols that are dependent on humans, and humans require incentives and are opportunistic. Software is not opportunistic. Software does not require incentive. Software, if coded right, optimally, is deterministic, is going to execute the way it is currently executing in the future no matter what. And that means everything. So we started the stream obviously highlighting the complexities of current macro financial conditions, and that gives us pause when talking about opportunity. And it's always prudent to start any conversation with such consideration. Then we talked about how the few systems in the crypto market have real-world significance, and what those systems are with regard to real-world, real economy and financial economy, enterprise potential. Then we talked about a relatively novel enterprise opportunity that has emerged in crypto markets that speculatively may have a historical existence if you think from an FX arbitrage opportunity perspective. I don't know if it exists in the real world, but it certainly exists here, and that is liquidity financing and vote rental as an enterprise opportunity. So it has overtones of dividends, but it's not quite the same. Dividends with regard to enterprise cash flow, that's like base V curve fees, and that's significant. But it's a relatively small rate of return, which means you have to think from a value investing standpoint. And from a value investing standpoint, that rate of return is not significant. It's not a viable investment because it's significantly lower than the risk-free rate of return. And do we expect the volatility to be accounted for in the amount it's paying? No. So that's imperative to understand in a rising interest rate environment. We cannot look at this market as we looked at stocks and crypto in the 2010s. It's dead. I don't see any reasonable way to argue there's a return to a lower interest rate environment, which means lower lows, lower highs over time. I mean, we literally went to zero for, on average, all of the 2010s. And that's even been stated to be specific policy of the Fed, and it doesn't make any sense how we get back to lower lows. And then we could look at that from a technical standpoint for the fun of it. So this is all relevant. So, and we'll get to the fun stuff. But if you zoom out to stuff like the 6-month on the 10-year, we already have higher highs. You're going to have higher lows. It doesn't make any sense to have higher lows because the world is not unipolar anymore. It's multipolar. So energy is going to be bifurcated where the energy goes. So it's going to be contentious. We're going to have higher commodity prices, higher energy prices in aggregate. And that is going to put pressure on currencies, going to put pressure on the bond market, it's going to be pressure on the rates because the rates are the incentive to actually buy the government bonds. And we're talking global here. So you need higher rates to drive incentives. The growth narrative is dead. I state that. That's my opinion. And I think the return of value, we're there. And the future cycles, the liquidity cycles, we're going to see significant capital flow, redistribution, reallocation of capital from growth to value. Value is cash flow. How much is paying you? It's actual revenue. And when you're an owner of enterprise that give you cash flow, you yourself are an enterprise. You're an owner of cash flow. So you can model everything you do from an asset ownership perspective in terms of a business that has cash flow. And that's important from an accounting perspective, a tax perspective, so on and so forth. It changes the entire equation. No longer are we sitting back looking for 10x's and 100x's and 1000x's and just capital gains, player versus player, the biological narrative that I have told many times that will present opportunity in the future, but I think that's not where the real opportunity will be. And that's because I don't want to do more work, I want to do less work. So in forming this enterprise that I have described over the last years, what I'm looking forward to is these 30% returns, 20% returns, even 15% returns. Why? Because it's significantly above the risk-free rate of return. It exposes you to the principal appreciation of these assets in a time where I expect a monumental wall of capital to redistribute from the growth narrative back to the value narrative. And this is an enterprise that is along the Metcalfe's law adoption in a field that is dealing with dollar liabilities, the concept of FX. The markets are flooded with credit systems, and the world operates on credit. So to appreciate maybe the opportunity that I see is there's such a small amount of liquidity in this environment. And why would liquidity flow to the crypto markets? Because of friction arbitrage. These systems are permissionless and they're global. It eliminates counterparties. And capital flow is the inverse of friction. So in a permissionless environment, this is going to be a destination of capital in the future based on that reality. So time is the only component of that equation. So in a capital redistribution capital redistribution cycle over the coming years, trillions of dollars start to flow through these systems in 5, 10, 15 years. The principal of these assets are going to reprice significantly, cash flow specific assets. So I don't expect the multiples you get from a degenerate growth perspective. I'm not looking for 1,000x. That's unreasonable in so many ways you could talk about. But if you could expect a 5x, that's crazy from a traditional, even growth narrative perspective in equities. But let's say you get a 5x over the next 5 years on principle that's 25% productive. These yields are not inversely proportional to the price point. These aren't fixed rate dividends like for REITs. REITs vote on dividend rate, the yield, and that yield is fixed. It's relative to how much they're willing to pay from cash flow post, everything that's left over past OPEX, operating expenses. So as the price point on a REIT, a stock ticker, goes down, the relative yield goes up. Now that is the case for base VECRV, because that is as comparable as you get to a dividend as anything. But this revenue right here has no counterpart in traditional finance. There's nothing on the stock market that's even comparable to this revenue source. This is not tied to the price point of CRV. Obviously, anything that's paying in CRV is. But these cash flow sources that are not CRV denominated are third party. So my expectation or speculation, hope to a degree, is that you see 5x returns on principal in the next 5-10 years, and you're still seeing the 25% APRs. I don't think the APRs fall. I think the APRs remain significantly above the risk-free rate of return. I see the potential for the expansion of this list to be endless from a liquidity financing perspective. These are all third-party companies, and this list is filled a lot by Frax. So you literally have the Frax narrative in there, which is dealing with U.S. sovereign debt and what they're doing. So the potential there is an entire conversation unto itself. But look, Abracadabra's been in there for a long time, and there's plenty. Threshold Network, which is Bitcoin as collateral, so that's a big deal. Paladin's making moves, obviously. Lido's in here, and this list makes sense to expand because if you want to create an enterprise in the crypto markets, you can't have it a liquid asset. That makes no sense from a best situation perspective. You want a liquid asset. So you want to finance liquidity, even small. So you start small and then you see, oh, this is actually driving price to a degree. Overtones of a buyback. You're driving capital to disrupt circulating supply by driving into liquidity, which is free liquidity. So obviously liquidity, an LP position, is in trading. It's disrupting capital to a degree as long as the financing continues. So it's generally price appreciative liquidity financing. So you get the capital efficiency, so you're able to get a multiple on the amount of capital that you deploy. And that's why it makes very much sense if more enterprise are to exist in the future, this list will expand. And I don't see a bounds to that expansion. So there's two places to go with regard to right now. This is like the worst time to talk about this topic because of macroeconomic conditions. But this is where the cash flow is now. So from a speculative standpoint, I'm willing to talk about this topic because I often say if it's paying now and it's deterministic, it will pay in the future. So while these third parties that are financing liquidity depth is not deterministic, it's opportunistic, this software, this regime of liquidity financing is deterministic. So this liquidity financing regime will exist in the future. This place of enterprise will exist in the future. So right now, opportunity may diminish and will likely diminish over time. It will still be here and see a more favorable liquidity environment in the future. So overall, we discussed concept of dividends and cash flow and how this isn't the dividend, where VE curve base revenue of the protocol being distributed to owners is more akin to a dividend as compared to something like a REIT, that type of cash flow, and this is third-party cash flow. And we talked about how this cash being paid, it's not dollar denominated, so there's risk volatility there, price point volatility, but this is not tied inversely to the price point of CRV. These revenues are tied to the price point of the denomination in which they're paid. So we talked about where we are with these revenues and the significance of being greatly above the risk-free rate of return and the speculation of where these revenues will be in the future. The growth of the amount of third parties that are paying CapEx to finance liquidity depth is unbounded. And we talked about determinism, that this system will exist in the future. So it will see an increasingly liquid environment where cash is more abundant, cash in terms of dollars. So willing to talk about this topic because it's probably one of the few real enterprise or from a novel perspective opportunity in the crypto markets. You get interesting things like synthetics. I'm quite keen on what EBTC is doing, but that's not really outside the scope of like a synthetic or a derivative of some kind. It's still relatively traditional. It's novel. It's Bitcoin, and it's novel because of how they're structuring the protocol. So that's very interesting. But it's still traditional. You know, even AMMs are traditional in many regards. Credit is traditional. The whole world operates on credits. This is all there is, and I don't say that from like maximalist standpoint. I say that as Captain Frickin' Rational. What is truly unique in this space from a financial economy perspective? And this is the only thing that has overtones of uniqueness. Okay, so for folks that have V curve, your first destination is probably the Warden. Why the Warden compared to Stake Dow? Because the Warden is fixed rate. It has caps on the amount of votes that are being looked for to rent. So it's very limited. So there's not much opportunity unless you have a relatively smaller size of a V curve position. So you got to get your 53% on PAL, and you liquidate when you get your cash flow, or 21%. But look how many votes. There's 461,000. So if you're a user that has 100,000 V curve, great. You could take part and garner 21% APR. Now, the most important thing with regard to these APRs is expectations. 21% is significantly above the risk-free rate, so there's significance there. But that's not going to do what most people that engage with the crypto markets think it's going to do. 21% is relatively small. It's not the Olympus days of 10,000%. But it's real, and that's why I talk about this. It's significantly above the risk-free rate of return. It has all the other characteristics of enterprise and is forward-looking. So that's a freaking crazy number to me. 21% catches my eye. To me, that is significant. Because if you talk about 21% in terms of the equities markets and REITs in general, you're taking significant risk. But this 21% is not paid by the protocol. This is paid by a third party. It's in a different denomination. So it has a different equation to consider. And sure, you have the volatility of curve, so on and so forth. And you have the risk of vested interest, so on and so forth. But that is a different part of the conversation as compared to this enterprise construct that I have spent the last half an hour defining. So when more favorable conditions arise, you get 30%. You get the 30% obviously with relatively small ownership. If you have 1,000 V curve, and 1,000 V curve is a couple $100, sure, you could get 30% in your money, and you're getting $100 a year. It's getting 30%. So obviously, it's proportional to the amount of the portfolio position size. And sizing is another conversation, because sizing it must consider risk and what part of the portfolio is risk and how much risk, so on and so forth. So, but you can see how you're limited. Probably the only thing significant I can offer, because most of it is quite deductive, you're not getting 34% of your money if you have $500,000 CRV, because there's only $410 that are rentable here. So you have to be very considerate of the size of your position. If you have a small position, sure, you could garner 34%. But if you have a larger position, you're not going to be able to capitalize significantly there. For instance, with $1 million VECRV, this will pay $2,700 for the week. Now, 27%, that's unheard of in the 2010s. There was no 27%. The world was operating on ZIRP, zero interest rates. So this is an opportunity heading into a rising interest rate environment. Well, I hope this helps. The Warden You stop by first, you see the amount of votes that are available, 51,000, 88,000, and it's paying 21% of the money. That's crazy. That's a huge amount of return. And that's being reasonable, not degenerate. So we have to be not in growth mindset, but value mindset. So look up the dividend investors on Twitter. I'm not too fond of their narrative lately because they're still talking about 3, 4, 5, 6, 7%, like Realty Income Corporation is spitting out 6%. And I'm like, no, not considering 5.5% on risk free. You can't do it. Okay, if Realty Income Corporation gets cut in half on the price point and is cranking out 12% on the money, okay. Considering the amount of cash they have, and you have to look into their balance sheet, and it's a nice balance sheet, they have a tremendous amount of cash compared to their debt obligations, so they're very solvent. But it's not paying enough. You do a 2% drop in the principal on the day, and you're literally cutting out months of revenue on a 6% APR, so it doesn't compute. But when you're talking about 20-something percent, the equation changes. Plus, the speculative appreciation of principal in the coming years. And obviously, we could always go back to the macro conversation of where the hell global liquidity is going to go in the coming years in order to keep the system operating. So, first stop, Warden, check the vote rental caps. See if you have too much, so be respective of your portfolio and position size. Like if you have $1 million, you're not getting 2,200 here. This is about $2,200 with $1 million, but there's not 1 million votes for rental. So you got to go over here to see where there's more room, there's more capacity. Kind of light this week. It's a little early, but there's $500,000 worth of rentals on the table, give or take, 489,000 between Warden and Vote Market. This is it. This is where you get your vote rentals. There's two places. Now, Warden's doing a lot of interesting things, really Paladin. So I'm quite interested in their V2. That's exciting. So I could see potentially more cash flow on the table, and that's always nice to see. But your second destination is Vote Market because these are floating rate. So they will be fixed rate when you have the purple dot until a particular cap is reached. So it's looking for 17,000 votes. It's only paying $54. So unless you're looking for like $50 weekly revenue, all right, fine, you can entertain this, and maybe you could even dominate the position if you come in here with. But bear in mind, look at the proportionality. If you come in here with 20,000 and the total becomes 30,000, you're going to get 2/3. I mean, it's a simple proportionality. So you're going to get 2/3 of $54, which is not necessarily opportunistic. Obviously, if you're looking for $10, your position size is considerable. So to optimize, you have to weigh your proportionalities. You have to observe whether there's, well, maybe the purple dot in this equation changes it a little bit, but generally speaking, these are dilutive positions. So, if 6 million more come into this vote rental, it's going to dilute the APR by 50%. This will be down to 13%. So that is something significant to consider when you're adjusting your parameters for the week. So this is all weekly. You claim weekly. You could vote every, I think it's 10 days. Warden's paid weekly, obviously, as well. Very different equation for liquid positions, CVX, CRV, so on and so forth. You could delegate your VL-CVX to Paladin, which is what I opt for. Delegate your VL Aura as well. And you have the same types of conversations with Balancer and the same conversation with Bunny with regard to a Warden perspective. Now, there's no real rentals, and StakeDAO is actually interesting. I wonder who's accumulating SDT, but I like the opaqueness. I need to know who's accumulating. That's vested interest, and I want my vested interest to be software. So it's deterministic buy side. That's a big deal. So that leaves only one real opportunity. Looking forward, Whereas if there's no very clear, unambiguous set of contracts that are deterministically accumulating, then it's speculative. So I firmly put Bunny in that category, and I even put Balancer and Aura in that category. I mean, who's accumulating Aura? So Aura is obviously the convex of Balancer, but I mean, look, even Prisma came online and is accumulating convex, but there's others that accumulate convex. You know, Aladdin accumulates convex. So that's significant. At least there's one other layer. So you get that circular nature where another incentive layer is applied to incentivize accumulation of convex. So, but sure, that's how the real world works. What do you think? There's not incentives if you're buying bonds in a foreign country, and that foreign country is using some of its capital to accumulate U.S. bonds. It's the same circular thing that the entire other country, their fiscal policy is dependent on those U.S. bonds, especially if a good part of their financial economics is based on U.S. dollars. So that's just an additional layer of incentives used to accumulate their base asset of choice, which historically was U.S. Treasuries, the long end. And that whole conversation is why we talk macro, because that equation is changing. It's changing quickly. Let's go through some comments. Appreciate all of you. I rarely talk about protocols specifically, and then like operating procedures. And we always talk very generic and methodology and macroeconomics. So this is a rare one. It's a fun one. Raul, pleasure. Crypto conscious. Good morning, Casper. Any thoughts on redacted cartel and cash flow play? It's an ETF, in my opinion. It's subjective. It's a DAO, so they vote, and I'm not interested. I don't. It's not to say that there's not opportunity, but I rather they own assets just like this. They accumulate curve. They accumulate convex, or whatever the hell the composition is of their balance sheet. So inspect the balance sheet, and I just don't want the subjectivity. I don't want the people and the voting at the DAO level. I want determinism. I want to own literally just what they own. I don't need them to own the things that I want to own. I just go own the things I want to own directly. So that's generally my opinion. But there's clearly going to be a large opportunity for DAO ETFs. And I don't see that as novel. Compare in the traditional financial lens. Clearly, it's novel in the crypto markets. There's going to be only few surviving first protocols of that nature, and then sky's the limit as the liquidity in the system improves over the coming decade. But that's not what I want to own going in the next 5-10 years. Osarko, hey Cap, a pleasure. Leandro, hello. Casper, looking for the best auto compounder for liquid staking, CVX and CRV. Any suggestions? There's only so many. I mean, it's the best isn't necessarily. It's not. Don't drive yourself nuts. Everyone's always looking for the best. You looking for auto compounding to remain liquid? Was that the compounder, an Aladdin product? The compounder does stuff like that. What, the Union, the Llama Union? I don't use these products, but here's the Union. UCVRX, CRV, and UCVX. Here's your compounders. And they're liquid to a degree, so you could still liquidate your principal position if that's the portfolio composition that someone is wanting to entertain. So the Union does it. It's not like one does it any better than another. They all literally do the exact same thing. From a CRV perspective, you could consider obviously the Yearn product and the Stake DAO product. But the Stake DAO product, you probably want to have SDT in the equation, not STD. You don't want to have STDs in the equation. You can have SDT in the equation, and that the Stake DAO has the boost component. So that's considerable. Where that heads, I want to speculate less, and that's why I focus on X, Y, and Z. How much does it cost? How much is it paying? And how likely is it to continue paying into the future? And that's why the only maximalist I am is a base layer maxi. Simplification is my game. Casper, hope that helps. Critical mass in the house. JM, so if I bought 100,000 curve at $1, drops 33 cents, and my curve is now getting 1/3 of these listed returns. No, your curve is now getting the exact same amount of returns because you are paid here per VECRV. You are getting paid $0.00378, which is cents. So divide by 100, you're getting paid 0.3 cents per VECRV. Has nothing to do with the price point of CRV. So obviously, if your principal depreciates, you could think of this in terms of dollars, how much you're getting paid per dollar of investment, and clearly you're not performing well from a total portfolio perspective. But then you're a different type of portfolio manager. Now you're a portfolio maxi. And that's literally the base mode of operation for the vast majority of people that entertain investing. They want their total portfolio to always go up in value. And that's not something I entertain anymore because that requires a lot of work. I'm a week over week cash flow analyst, and I'm a budget balancer and a replacement of work income seeker. I want to know how much I make on a weekly basis. I want to purchase things that pay me on a weekly basis. Predominantly, I do entertain REITs and dividends that pay quarterly, and even not really U.S. bonds at this point. It's been a disaster. And I don't want to play that from a capital gains perspective. But U.S. REITs can be a good price point if we have a significant stock market correction. Realty Income Corporation starts paying 12% and the price point gets cut in half. It's pretty interesting. And we could start to see some interesting cash flow from equities. I would say hopefully. I just think it's been perverted. 6%. Fucking shit. No, I'm not buying your stock. It's paying 6% and risk free at 5.5%. That price point has to get cut in half. Yeah, 12% you're going to garner investors. So I'm a week over week maxi. I'm not a portfolio value maxi. And you will get criticized to all hell by noobs and just novice investors like, oh, you lost so much money since 2021. Yeah, if you pulled in 300 grand in cash flow and it's cash in a bank in 2022 and 2023, and that cash is what gets you to 2024 and 2025, which means you're liquid and you're living off that money, and that's work, that's income. And then in 2024, 2025, liquidity floods the system. Your asset prices reinflate, go back to where they were, maybe even speculatively higher. I mean, look at Bitcoin cycle over cycle. And you did no work in between? You did no work at all in 2022 and 2023 and still pulled in cash flow that helped you survive and live? And then in the future? So it's a different paradigm. It's contrarian. It's not making as much money as possible because that is, it's human, but I think it's short-sighted. And I think there's a better way to engage with markets that is more mentally healthy and sustainable. So it's a complicated conversation. I hope that helps. But what you said, JM, I hope I clarified. It's not the case. Still getting 30% of the money per VE curve. Your cash flow is unchanged. So it's proportional to the denomination of the capex that someone's using to pay you. Sir Joe, a pleasure. So XYZ is perfect. You buy X. Well, actually, it's not really perfect because your X just got cut in half. Okay. All right. I'll go on. I'll go on. Shisha. Hey, Cap. Are you going to sell your aura to Convex? I'm not doing anything today, and I don't really want to think about things quickly anymore. I want to think about things slowly, so I'm not going to be early in any modifications. Right now, my mode of operation is nothing. My mode of operation for almost all of 22 and 23 was just click a couple buttons a week and get cash flow and work on accounting and really have good books. So tax reporting is rudimentary. It's easy, and literally QuickBooks has made that ridiculously easy. Um, maybe. I don't know what I'm going to do. Definitely not going to do anything today. Um, I'm leaning more favorably to Curve ecosystem as compared to Balancer ecosystem just because of third-party recyclers and sterilizers. And I think that's really just a quantitative observation. Um, it's not an opinion. It's just what is actually occurring in the markets. Casper, thanks for the response. My plan for Redacted is mostly Europe dollar play for on-chain stablecoins with the future project Dinero. You got to have your narrative. Just, you know, it's not easy to construct a story. Just remember dinner table investing. You need to be able to tell a story to friends and family. And in order for that to occur, you need to be able to tell a story to yourself, which is a narrative. So my story is I don't own crypto. I own businesses, and these businesses pay a dividend. And traditionally, a dividend is paid quarterly and maybe monthly. The monthly dividend corporation, Big O. But in this case, these dividends are paid weekly, and it's not just a dividend. There's another angle to the cash flow, so it's not even comparable to a dividend when you're looking at on the screen here. You're literally talking about like being part of the organization. You're literally accounts receivable. This isn't even a dividend. This literally is accounts receivable. That's the best way to think about it. So you're settling with a third party company purchasing something from this enterprise. And this enterprise, you happen to control the part of the accounting department, their accounts receivable, and you're getting paid from the third party who's receiving something in return. And that's an interesting thing I haven't stated, but that's an interesting way to look at it. This is accounts receivable. This isn't a dividend. I hope that helps. Let's go back to macro for 2 seconds. Let's see where the dollar's at. Oof, punched 106 this morning. So the secular trend, I think, is still in play. Very still in play. I mean, that's a massive shooting star on the 6-month candle. I only look at 3 months, 6 months. I will not go down to the weekly and the daily. It'll drive you freaking nuts. So unless you breach like 115, I mean, come on. But to breach 115, sure, oil at 150 is going to do some wild shit. You get a collapse you start to see the 10-year at 7, 8, 9, 10%. Something was literally collapsing. You're going to see some weird shit go down. But as of right now, structurally, dollar depreciation, structural dollar devaluation over the next 15 years to keep the system going. And just remember, FX is relative. So literally every country on the planet prints dollar. U.S. tries to print more, and we just enter what Japan does, where, and frankly, the whole world has been doing it for the last 10 years, where the central banks are the buyer of last resort for sovereign debt. All right, so the system's going to get perverted. It's going to get really freaking gross and weird for the foreseeable future. So they devalue the dollar, and central banks are putting trillions more on their balance sheets. And you see in 2014, 2015, the Fed, U.S. central bank, has 14 to 18 trillion dollars on their balance sheet. All right, and then the market goes through another cycle. You have your bull cycle, your bear cycle, and over the next 15 years, you see the dollar get down to 60. Why 60? Because that's the lower low. That's the darn trend line. It just is what it is. It's the trend line. And then you see the dollar go like this. I mean, look, there's the structure. It's a speculative structure. There's plenty of reason for the dollar to go up, but we go day by day and we look at the data, and the end game, the whole system fails when the dollar goes up. The system doesn't end with the dollar going down. The system ends with the dollar going vertical in price, where all foreign fiat is used to purchase dollars, is used to pay debts, because the vast majority of debt on the planet is dollars. So everyone has to pay the dollar debt. Otherwise, one country gets pissed at another country because they owe them dollars. Dollar is much scarcer than anything that anyone can imagine. And all of that is based around energy. And really, to understand all of that, you have to go back and forth between Luke Gromen and Brent Johnson. But they're just, they tell the story spot on, and hopefully I simplify it and help folks. Tapsy's in the house. Much pleasure. Much a pleasure, friend. So the bond market's screaming higher. Look at that, 4.5. But look at that. You got the 200 SMA on the 6-month chart just above head. So what does that scream? That screams cycle. That screams, sure, it could breach through the 200 SMA. You're talking about the 200 6-month moving average. That is a massive time frame. And fine, you find resistance, and my expectation is predominantly something like 2.5%. Over the next 2 years, bonds fall back to trend, and this is a higher a resistance flip support. And to me, that is consistent with something like this. And if you turn the price chart off, and you turn off your drawings, and you turn off your SMAs, and here's your time-weighted average price, I expect something like that to play out, where you start to see higher lows and higher highs structurally. Structure is everything. Directionality is everything. Directionality persists until capitulation, and then you get reversal. So the reversal here is higher lows and higher highs. And what does that do to how you have to manage your portfolio? It means growth is fucked. The concept of growth, where you buy a stock and it goes up 50% a year, it's dead. Growth's not going to be there. Maybe in tech, maybe just like in crazy tech, as Raul talks about. Fine. But from a crypto standpoint, what's the enterprise? What's the business? Finance. And what finance? Dollars. What dollars? Liabilities. And what does the world run on? Dollar liabilities and credit. And what do you need more for the world to continue into the next 15 years? Credit. The whole system is dependent on credit flow and rolling over and refinancing. So this here just screams the reemergence of value and cash flow, and growth is dead. So what do you want? You want yield. So how do you do that? X, Y, Z. How much does it cost? How much is it paying? And how likely is it to continue paying into the future? And what's the best way to simplify that equation? Get rid of the people. Get rid of the humans. Software, determinism, immutable contracts that will pay in the future. So what's the likelihood that they will pay? That's greatly increased because of immutable software. I'm going to wrap it up for today. That was a good one. Hopefully I told a decent picture, real world, the real economy, the financial economy, and what actually is the enterprises in crypto markets, and not bullshit, not vaporware that does. Most of it, even the financial enterprise in crypto markets, does the same thing as traditional finance. So what is innovative from a financial perspective? So the only real thing that's innovative is liquidity financing. And the only other thing that has done this sterilization is the United States over the last 50 years, since the 70s. That's it. And all we see is the hint that is occurring, and it's going to grow into some massive, like 10,000 protocols, or sucking curve circulating supply out of the market. We see the hint because we see the protocols. You see them. They exist today. They're sterilizing, and they're recycling. And you get the same feedback loop that occurred in the sovereign world for the nation state that started 50 years ago, and it turned into what it is today. So that's my investment thesis. And that's what I would tell at a dinner table. And if there were freaking worldwide macroeconomists, like well-known folks at the dinner table, and I told this story, they'd be like, all right, that's a narrative. That's a story. It makes sense. It's rational. What kind of risk profile is attached to it? That's another story. But then, obviously, from a personal perspective, I have a structure to the portfolio a certain way to account for the risk and the volatility. The directionality, I expect to be reasonable, but there's volatility, which means do we have enough cash to traverse the volatile periods? Oh, fortunately enough, these things are paying cash flow in a value reemergent type of scenario. The complexity that people have to get their heads around is the secular trend shifting. Growth is dead. Value is reemergent. If Warren Buffett was younger, he would love this shit, but no one's told him this story. This is right up his alley, but it's obviously out on the risk curve because it's just starting. But the value is here. Speculatively, if it plays out the way it looks like it's going to play from a directionality perspective, this is pure value. This is value. This is owning a business that has no people. It's pure software. And that is tantalizing because most risk comes from people. Everyone have a good day. Monday, September 25th at 12:30 p.m. Thank you all for joining. 20 people made it to the end of the stream. 13 likes. Smack that thumbs up button. Hit that like. Hit subscribe. I appreciate all of you. In the description is the most rational community in the entire crypto space. Oh, it's going to be fun in 24 and 25. I'll see you later this week. Peace.